Are you watching inflation and the wild market swings and kind of wondering if your retirement savings are going to make it? Well, you're definitely not alone. It seems like every time you turn around, prices are up and traditional portfolios are struggling. Protecting your future has never felt more urgent. So today, we are going to build a modern playbook to do exactly that. Here's the game plan for our time together. First, we're going to take a little trip back in time to a lost decade for investors. You'll see why that's so important. Then, we'll assemble our inflation-proofing toolkit. After that, we'll get into the nitty-gritty of building a secure income floor, adding some rocket fuel for growth, and finally, tying it all together into a retirement blueprint that's built for today's world. You know, to really get a grip on the challenges we're facing now, we have to look back, specifically to the 1970s. It was a period that honestly still gives investors nightmares because it just threw out the entire rulebook on how markets are supposed to work. And the villain of this story has a name: stagflation. It's this incredibly rare, toxic mix. See, normally, high inflation happens when the economy's booming, but stagflation? Man, it's the worst of all worlds. You've got soaring prices, but the economy's stuck in the mud and people are losing their jobs. It is an absolute nightmare for any investment portfolio. And if you want to see just how brutal it was, look at this. This chart says it all. After you factor in inflation, the S&P 500, the stock market, lost almost half its value. A whole decade gone. But then look at gold. It didn't just survive, it went on an absolute tear, gaining over 2,000%. This incredible difference tells you everything. During stagflation, where you put your money is everything. So what do you do when the old playbook fails? How do you fight back? Well, it's time to open up the Inflation-Proofing Toolkit and see what kinds of assets didn't just ride out the storm, but actually thrived in it. And this quote right here from Guy Weldon, it really just hits the nail on the head. It all comes down to finding businesses with something called pricing power. What's that? It means they're so essential, so dominant in their market, that when their own costs go up, they can just turn around and pass those costs right on to their customers, protecting their profits and your investment. You can see this period just created a massive divide in the investment world. On one side, the winners were tangible, real things you could touch. Commodities like oil, real estate, precious metals. Even certain types of stocks like value and defensive ones did okay. And the losers? Oh boy, pretty much all financial assets. Bonds got absolutely crushed by rising interest rates, and all those high-flying growth stocks that were the darlings of the 60s, they got hammered. So you might be thinking, okay, great history lesson, but what about now? Well, these lessons from the 70s are more relevant than ever. Today's savvy investors, especially in the world of private equity, are actively hunting for companies with that exact kind of pricing power. They use these buy and build strategies, where they scoop up smaller companies to create one big dominant business that has way more control over its prices and can handle an inflationary storm. So how do we actually apply these lessons? Well, it all starts with building a rock-solid foundation of security. Before you can even think about growth, you need to build a floor of predictable, inflation-proof income that will cover your essential bills, no matter what the market is doing. And the key building block for this floor is a really special kind of government bond called TIPS. The name says it all: Treasury Inflation Protected Securities. They are designed from the ground up to protect you from inflation. When consumer prices go up, the actual value of your bond goes up right along with it. It's a direct way to make sure your money keeps its buying power. But here's a really important detail. How you own TIPS makes a huge difference. You could build what's called a ladder with individual bonds, where each one matures in a different year to cover that year's expenses. It's like having a guaranteed inflation-adjusted paycheck. The other way is to just buy a TIPS fund, which is easier, sure, but it exposes you to interest rate risk. If rates rise, the value of your fund can actually go down. So for that guaranteed income we need for our secure floor, the ladder is by far the tougher, more reliable choice. Okay, so once we've got that secure floor in place, it's time to have some fun. It's time to add the engine for growth. And this is where things get really interesting, combining that rock-solid safety with a component that's designed for some serious upside. This brings us to a really innovative strategy called the floor leverage model. The idea is actually pretty simple, but it's incredibly powerful. You intentionally separate your money into two different buckets. One is the big, safe floor for security. The other is a small, high-risk bucket designed to basically turbocharge your growth. So what does that look like in practice? Well, here it is. The vast majority, we're talking 85% of your money, is dedicated to that ultra-safe floor, like our TIPS ladder. And then only the remaining 15% is put into the leverage sleeve. Now, this is often done with a high-octane tool like a triple leverage stock ETF. It's designed to amplify market returns, which makes it high risk, sure, but it also gives you concentrated potential for gains with just a small amount of your capital. So how does this all work together? It's basically a simple 3-step cycle. Step 1, you secure your income with that big 85% floor. You can sleep at night knowing your essential bills are covered. Step 2, you go for aggressive growth with that small 15% leverage sleeve. And then step 3, and this is the real magic, you periodically harvest the profits from your growth engine and you use them to buy more flooring. You're literally using your gains to make your secure income stream bigger and bigger, year after year. All right, we have covered a ton of ground here, from the stagflation of the 70s all the way to some pretty advanced modern strategies. So let's kind of land the plane and pull it all together, focusing on the key ideas you can use to rethink your own retirement plan for the world we live in now. So what are the big takeaways? First off, that classic 60-40 stock and bond portfolio, it's just not going to cut it anymore. You have to diversify into real assets. Second, focus on quality. Hunt for those companies with strong pricing power that can protect themselves. Third, be really intentional about separating your money into a bucket for safety and a bucket for growth. It's a much smarter way to manage risk. And finally, you gotta have a dynamic strategy that can adapt, not one you just set up once and forget about for 30 years. And that brings us to our final thought, a question you really should ask yourself. Take a good, hard look at your own strategy. Is your portfolio built on the assumptions of the past decade? Or is it truly ready to handle the inflation, the volatility, and all the uncertainty that's going to define the next decade? The playbook has definitely changed. It's time to make sure yours has too.